Welcome back and Happy New Year. So I wanted to originally do a video on Mastercraft. However, I decided I'm going to pile a bunch of other boating companies in with it because that's been something that people have asked me. So why not knock this out, right? So I have one new on here, or One Water Marine, HCO, which is Marine Max, Marine Products, MPX, Malibu, and Mastercraft. These two are the ones that people have been most interested in the comments, so we will talk about them a lot. But I've done a video on One Water, so we'll talk about that one as well. All right, so the big story here is that all of these stocks are at the bottom end of their 52-week range. They've kind of taken a beating. One Water especially, Marine Products especially, they're both very much near the bottom of the 52-week range. Mastercraft and Malibu have kind of come up a little bit, but they're still at the bottom. Same can be said for Marine Max. So what I did is on Seeking Alpha, I made my own view, and we'll start with this, but then I'll do a deeper dive on most of them, if not all of them, and go from there, right? So first of all, market cap, look, none of these are over $1 billion. You know, the most expensive one, or the highest market cap, is Malibu at $730 million. Before I go any further, I do want to clarify that One Water and Marine Max are distributors. They're not necessarily manufacturers, whereas Marine Products, Malibu, and Mastercraft are manufacturers that, I think they also have some sales and stuff, but these two are the distributors, the dealers, however you want to call it, and then the other three are manufacturers. So the first thing that catches my eye is the debt on these first two. I mean, they both have over $1 billion of debt, very little cash compared to that, and I mean, their debt is, in One Water's case, is what, 3.5 times the market cap. I mean, that's kind of crazy. And I'll open them up to show you, because it used to not be the case. If I go to their financials here and I go to their summary, or their financials tab, what you can see, and I'm going to go to the balance sheet to show you, they've really changed their balance sheet in a big way in the last year or so. So I mean, they went in 2021, 200, that's current assets, but total assets, they just had this huge jump up in total assets. A lot of it is, some of it's goodwill right here, which was an acquisition, has to be, right? That's what goodwill usually is, but a lot of property, plant, and equipment. But what also has happened is that debt has just skyrocketed. So the debt's gone up from 200 to 1.2 billion. So that's kind of a red flag for me. The last thing I want to have with depreciating inventory is a lot of debt. So I'm going to be partial here to the ones that have low debt. And honestly, that's enough to make me really skip over both of these. One Water and Marine Max. It's just not the business I want to be invested in. I'm not saying it's going to do bad or anything like that. I just sleep much better at night if I know that the companies I own have little to no debt. All right. Speaking of little to no debt, look at this one, Marine Products. This one was kind of unknown to me. I know some people have been commenting about it, so I'll go ahead and read the description. Let's see. All right, they design, manufacture, and sell recreational fiberglass power boats for the sport boat and sport boat fishing market. So yeah, just boat manufacturer, right? They sell to a network of independent authorized dealers. All right. So this one, what I think is interesting here is, well, first of all, that no debt, right? So if I go to the balance sheet, you can see that, let's see. Yeah, it's not even a line item. There's no long-term debt as even a line item. It's crazy. It's like it's never been that way. That's pretty awesome, right? That's exactly what you want. I looked at this one a while back, and my hesitation was that I thought that they were doing too much to dividends and should have been doing more towards buybacks. And I'll just kind of show you what I'm talking about here whenever this loads. All right, so here's their cash flow statement. Keep in mind that their market cap's about $317 million right now. All right, so I'm most interested in cash from financing. All right, so here we go. Look at this big jump up, trailing 12 months, 40 million, so I would, and look what they did with it, all dividends. It's crazy. They're paying all of their financing cash flow almost towards dividends. Whenever it was 20 million, 19 went to dividends. Whenever it was 17.8, 17.1 went to dividends. Very little is going to repurchasing, which is interesting to me because, I mean, if you have that much money to spare, well, let's look at their free cash flow. Their free cash flow, $1, 136, 137. I mean, let's take the average of 137 and 105. That's 105 divided by 2. So let's say $1.21 per share, and the stock price right now is $9.15. I mean, that's a 13% yield. I think that buybacks would be better than dividends, right? But, I guess dividends are at least guaranteed. So I could see why people love this, who love dividends. I just, I don't know. I'd prefer buybacks, but it's just because I think you get more bang for your buck if the stock is undervalued, which I think this one is. Now let's go back to the boats. All right, so Malibu versus Mastercraft. What you're going to see is that these are very similar. They both have very little debt. They're buying back shares at a rate that's roughly, let's say, 5 to 6% of the market cap. I think the difference here is valuation. That, and personally, I think Mastercraft is more of a name brand in my area. Like, it was almost used interchangeably with ski boats, with water ski boats. Was like, oh, he has a Mastercraft or something like that. So anyway, I'm a little bit partial there, but honestly, I think that these two both really bounce around depending on the price. Like, I could see owning both of them. I have owned both of them. Right now, I only own Mastercraft because I thought it dropped recently to a low enough value that I traded some Malibu for Mastercraft. But I'll kind of show you what I'm talking about. So if I go to the cash flow, and this is what I really judge a lot of companies on, is the cash flow statement. And scroll all the way down here to the bottom, free cash flow per share. All right, so they are, have barely started making money again after that big trough that happened after the boom that was post-COVID recovery, right? So, I mean, if you look at the pattern, they were just sitting here at 2.2, had a little bit of down for COVID itself, and then just skyrocketed up to almost $6 a share. Then they fell back down, and the idea is that as the economy recovers, it's going to come back, right? So what I want to do is say that they'll get back to the average of 21, 22. So, I mean, they were at 230 before COVID, and I think that they're growing, and it's anyway. Let's say they get back to the average of those two, which would be 2.3 plus 3.3 divided by 2, so $2.80 of free cash flow per share. All right, currently $2.80 on $18 is going to be a yield. What I did is I divided by the share price. That's a 14.9% yield. So call it a 15% yield. Pretty good, right? I think anybody would take that kind of yield. Is it, even, let's say even they just go back to the what was it? Let's say they go all the way back down to just like 230 again and don't even forget about this boom moving forward. 230 divided by 18.78 is a 12% yield, which again is great. Okay. All right. Now let's pull up Malibu. All right. And for them, I'm going to do the same thing. I'm going to go to the cash flow statement. Keep in mind they're about $37.30 per share. Go all the way down here to free cash flow per share. They went as high as 6.34. Now remember, Mastercraft was 5.9. So the Mastercraft bump was almost as high as the Malibu peak, but Mastercraft is selling for $18 and Malibu's selling for $37. Okay. If you're going off of peak earnings, but you're not going to want to go off of peak cash flow or earnings. All right. So let's say they get back to, I think I used 2021 as the conservative, but let's do the same thing. 485, the average of 485 and 529. 485 plus 529 divided by 2, and then the stock price is 37.30, so divided by 37.30, 13% yield. And the if they just did 485 divided by 37.30, 13% yield. So honestly, these two are neck and neck in my opinion. I could see investing in each one. Like I said, I have owned each one. I think that a lot depends on what price it's selling at. But that's all I really have. I know it's a short video. It's kind of surface level, but I wanted to group them all together and still do a short video. So what I'm doing is keeping a close eye on Malibu and Mastercraft. And I might be swayed for marine products, especially. Remember, they're the lowest towards their 52-week low. So, who knows? So anyway, that's all I have. I hope you enjoyed it. I hope you learned something. Comment what you think, and I'll see you next time.